All right, let's take a seat. As I mentioned in my opening remarks on MicroCapClub, we brought on Ryan Telford to be our head of evidence-based research, just to look at all the quantitative data and all the evidence. And he's already, started, I don't know, probably a dozen threads on MicroCapClub, just kind of looking at where the alpha is across those three geographies, and it's really interesting. And he's going to be sharing some of that with you today. But the one thing I love about Ryan too, he's an eclectic background. So he's an engineer, a mining consultant by day that does quant work at night, which I think is pretty cool. So let's welcome Ryan.
Thanks, Ian, for that introduction. Really great turnout here today, and look forward to chatting with you guys after. Let's talk some shop on MicroCaps. Full disclosure, I'm not holding any of the positions that I mentioned today. Many things can be said about MicroCaps. MicroCaps are illiquid and speculative. They're more likely to be 10x than other stocks. MicroCaps are just biotechs and banks. MicroCaps are cheap for a reason. MicroCaps are inefficient, but can provide high returns. MicroCaps are ideal for the retail investor. Canadian MicroCaps are only pre-revenue mining stocks. And investing in Europe will make you Euro-poor. These are but a few common perceptions of MicroCaps I've come across, both by the general investing public and even within the MicroCap community. And by some of the opposing points here, it's no wonder that MicroCaps can be misunderstood. But being able to cut through the noise and get closer to the truth can benefit us both as MicroCap investors and also provide awareness as to the potential opportunities and pitfalls in MicroCaps. This is what evidence-based investing is about, using data to inform our decisions rather than relying on theories, conventional wisdom, and famous quotes or anecdotes. Many platforms are available to access historical data. I'm sure you've used a few. I personally use Portfolio 123 for its high-quality data and ease of use, and much of the underlying data presented here today is provided by Portfolio 123. Perhaps an obvious question for this audience, but what are MicroCaps? There can be varying definitions, but strictly speaking, we're looking at stocks with less than 300 million in market cap with some minimum liquidity. But again, just keep in mind that liquidity can be very subjective and varies for each investor. And we can break it down even further. Anything less than 50 million, you can consider a nano-cap, and below 10 million, a pico-cap. Of the more than 14,000 publicly listed companies in the US, Canada, and Europe, nearly 1/3 are liquid microcaps. But of these 4,000 semi-global microcaps, we have varying types of stocks, differing in their sectors, their fundamentals, their maturity level, their country domicile, just to name a few. Let's look at some very basic fundamental groupings. Microcaps with revenue versus pre-revenue, growing revenue versus shrinking revenue, profitable versus unprofitable, and profitable and growing their earnings versus profitable and shrinking their earnings. What does the data say about these groups? For some initial perspective, let's look at these groups in US large caps, S&P 500, which is often broadly referred to as the stock market. In the S&P 500, every single stock has sales. Nearly all of them are profitable, and more than half of them are growing their earnings. In market caps, it's a very different picture. Not all market caps have sales, and certainly not all market caps are profitable, as most of us know. And we see high variation between these groups, between US, Canada, and Europe. In Canada, for example, just over half of market caps have sales, meaning the other half are pre-revenue, compared to higher proportions in US and Europe. Europe, on the other hand, has a higher proportion of market caps in each of these groups compared to US and Canada. From these values, it may even suggest that European market caps are higher quality than US and Canada as a group. And the performance can vary greatly between these groups. In the US, a universe of all liquid microcaps, equally weighted, balanced quarterly, would have produced an annualized return of nearly -5% in the last 10 years, versus low to high teens for the US major indices. But if you looked only at this stat, you might think microcaps truly are junk. But when we start to peel back the layers, a very different picture begins to emerge. As we move up our ladder of microcap groups, returns gradually improve. In the US, microcaps with sales still beat all microcaps, still negative. Microcaps with growing sales, slightly better. Microcaps that are profitable, returns are now positive and beat all microcaps and the IWC benchmark. Even better if they're growing earnings. In Canada, we see positive returns across the board. And then again, there's Europe, where our microcap groups have outperformed both the US and Canadian microcaps in the last 10 years. Sometimes investing in Europe has been called Europoor, but according to the data, I'm not so sure this has been the case, or at least when it comes to our groupings here. These returns are over a long 10-year period, but during that time, there have been many up and down periods in the market, and our microcap groups have performed differently during both. In this case, an up market is when the IWC benchmark is positive, and a down market when negative. Since 1999, overall, profitable and growing microcaps have outperformed all groups in all markets. But in up markets, it's the unprofitable microcaps that have slightly outperformed those that are profitable and growing. Bottom left chart. Perhaps a sign of more market speculation and risk-taking. In down markets, it's the profitable and growing stocks that really shine, with the least negative returns of the groups, bottom right chart. You could even interpret this as a flight to quality during periods of market volatility. And let's not forget sectors. A common stereotype in the opening remarks for the US was that microcaps are just biotechs and banks. What does the data say? In the US, this is actually true, with half of liquid microcaps being financials and healthcare. In Canada, nearly 2/3 of microcaps are resource-based, mining and energy. And in Europe, we're fairly balanced across the 12 sectors. So in microcaps, with such variation and such basic characteristics, it can be difficult to put microcaps into a one-size-fits-all box. It's likely part of the reason why microcaps can be misunderstood. Long-term growth is one aspect of microcaps that's often hotly debated. The two most common opinions being, microcaps have long runways for growth, or they're too small to grow and can even be cyclical. What does the data say? As a group, over the last 10 years, US microcaps have lagged large caps in terms of sales growth, with a median annualized sales growth rate of 4% versus the S&P 500 just over 6%. 2 percentage points may not seem like much of a difference, but this is a 50% difference per year. Compounded over 10 years can be quite significant. Microcap sectors with notably lower growth than the large cap cousins have been consumer services, consumer cyclicals, healthcare, and tech. So from this data, microcaps have tended to have less of a growth runway than large caps. But what is limiting their growth? Cyclicality may provide some clues. We all know the term cyclical, but what's it look like and how's it measured? Sales growth is one of the most basic fundamental measures for a business, and over time, tends to be less noisy than other measures. Here are some examples. Amazon, a great illustration of a secular grower. While it has had some cycles in its growth pattern, it successfully managed to keep sales growth positive since 2002, above the horizontal axis, without a single year of negative growth. It has, of course, had periods of decelerating growth, where it slopes downwards, but growth has remained positive. Taylor devices. It's a microcap that some of you may be familiar with. And full disclosure, I have been a former shareholder. As we can see, its sales growth cycle has wavered back and forth from positive and growing above the axis to negative and shrinking below the axis for over 20 years. If history is any guide, the Taylor Devices is approaching its 5th trough phase of its cycle since 2002. And not to pick on Taylor, but this can be a common pattern for many microcaps, in fact. IBM has had a clear positive and negative cycle in the 2000s and early 2010s, but in the last 10 years has spent more time in the negative growth part of its cycle. These are qualitative descriptions, but how do we measure, quantify the cyclicality of companies to make objective comparisons? Data, once again, can help us here. I've created a measure I call the cycle score, and actually I haven't spoken about it before this conference publicly. But very simply, it's the ratio of the positive cycle time to the negative cycle time in sales growth for a stock over a given period. A stock is scored from +1 to -1, score of 1 being an all secular growth stock, as we saw with Amazon, 0 to 1 being a positive cyclical, spending more time in a cycle in positive growth territory than negative. Like Taylor Devices, the higher the number, the less cyclical. From 0 to -1 is a negative cyclical, more negative growth than positive, like IBM. So now that we can measure cyclicality, what does the data say? First, S&P 500, with a median cyclical score of 0.73 over the last 10 years. Still cyclical, but higher end positive. US microcaps, as a group, have had a median cyclical score of 0.58, suggesting microcaps have been 25% more cyclical than larger caps in the S&P 500 over the last 10 years. Notably, more cyclical sectors for microcaps versus large caps have included telecom, tech, business services, and consumer cyclicals. We also see a higher spread in cyclical scores between the lowest and highest microcap sectors compared to the S&P, which is yet another example of high variation within the microcaps universe. So while often we hear about stocks being either cyclical or non-cyclical, we can see that cyclicality actually follows a spectrum when measured this way and can vary widely between sectors and even time periods. We can also measure cyclicality in Canada and Europe. Cyclicality in Canada has been similar to the US, with Canadian microcaps being more cyclical than the TSX and all stocks with a lower cycle score. In Europe, very interestingly, microcap cyclicality is actually slightly less than large caps. Now, Europe is a vast universe, and I hope to dig into this more in the future. Either way, it's another example of variation within our microcaps. Cyclicality is neither good or bad, but understanding microcap cycles and its industries can provide some clues as to what its future growth profile may look like. Cyclicality can also help estimate the bottom of a stock cycle, aid in marking a top when the stock may have reached peak capacity and could be in for some challenges ahead. Or there may be a turnaround opportunity in finding a historically negative cyclical stock. Microcap's tendency to be more cyclical is the reason that timing in microcaps can be an important but often underestimated aspect of microcap investing, something we'll touch on later. So on the whole, if microcaps are more cyclical than the large cap cousins, then what about those microcaps that are able to become multibaggers? In fact, microcaps can become multibaggers, and we'll differentiate two types. Short-term multibaggers, which is 3x or 200% or greater in the last 3 years, and long-term multibaggers, 10x or 900% or more in the last 10 years. These are high returns. Just for perspective, the S&P has returned 32% and 224% over our short and long-term periods, respectively. Now let's look at the numbers. In the last 3 years in the US, there have been 47 short-term multibaggers, 16 of which were initially microcaps, about 34%. And 181 long-term multibaggers, 35 starting out as microcaps, 19%-ish. So the big question, what has driven these high returns? Using historical data, we can break down the specific return factors and their contribution to overall return, and this is for any type of stock, regardless if they're multibaggers or not. For our purposes, we'll look at earnings growth, which is composed of sales growth and profit margin growth, multiple expansion, and dividend growth. We've got our framework. Now what's the data say? For our short-term multi-baggers, in aggregate, for all stocks, earnings growth is driven about 2/3 of the returns, roughly equally between sales growth and margin growth, with multiple expansion taking up another 1/3. For our sample, for microcaps, earnings growth is still more than half of the return, with more of an emphasis on multiple expansion compared to all stocks. Long-term multi-bagger drivers in our sample have varied from the short term, as earnings growth has driven up 90% of the return, with multiple expansion having less of an impact and the remaining return in dividend growth. And looking closer at earnings growth, sales growth has driven roughly 50% of returns for both stock groups in the long term for our sample. Ben Graham famously opined on the stock market and voting in the short run and weighing in the long run. If you'll indulge me, if multiple expansion is a proxy for voting and earnings growth a proxy for weighing, then maybe he was onto something. But for our sample, even weighing has an impact in the short run, at least when it comes to our multi-baggers in our sample. These are but a few data-driven findings that can help inform our investing decisions. Now, let's put it to work in investing strategy. The framework is something I call GUTS. And some of you may be familiar with it already. I speak about this quite a bit on Twitter. Quite simply, GUTS is growth, undervalued, timing, and sentiment. Where growth is composed of sales growth and earnings growth, including margins. Is the growth slowing or accelerating? As we've seen, many microcaps can be cyclical in nature, so this can be an important distinction. Undervalued, the value component. As we saw, multiple expansion can be a driver of returns, particularly in the shorter term. So the lower the valuation, the better. But many microcaps are cheap for a reason. So a low valuation on its own may not be as helpful, but can be quite useful when combined with other factors. T for timing. Can you time the market? Conventional wisdom says no. But I'd argue that you can time your stocks when you buy and sell in particular. Fundamental momentum can provide some clues, especially as market caps can be more cyclical. And price momentum, when the price is rising, can be a very effective measure. It means that the market is seeing value in the stock potentially. And finally, sentiment. While it's important to do your own work, you can always find some clues from what other market participants are thinking. What are the shorts doing? What are the analysts saying? How's the mood changing? And these are all quantitative measures, in fact. So let's get even more specific to create a ranking system. Growth, we'll use earnings per share growth plus sales growth higher the better. Undervalued, enterprise value to EBIT multiple, the lower the better. Timing, price momentum, higher the better. And sentiment, short interest, lower the better. We can then rank all stocks in our liquid microcap universe with these factors, equal weight, and rebalance quarterly. This looks good on paper, but what does the data actually say about this strategy? How's it performed? This rank chart shows the annualized 10-year performance of GUT's strategy, rebalanced quarterly, and broken down into deciles based on excess returns. The highest ranking 10% of stocks, furthest right, dark blue. Next highest 10% ranked, second to right, all the way down to the lowest 10%, which is the orange. The highest ranked stocks in our GUT strategy has had an annual excess return of more than 14%, and the lowest decile, negative 33%. In rank charts, a favorable sign is a sloping downward pattern of the rank's performance, as is the case here, as shown by the blue line, and can be indicative of a potential signal in a ranking system and its underlying factors. If the deciles were more random, then there's more potential for noise than signal. A rank chart's a good first step, but how can we use this? But now we can use a simulation to add many other constraints, including frictional costs, such as commissions and slippage, and add specific buy and sell rules, adjust holding weightings, just to name a very, very few. Here's a 10-year simulation of our GUT strategy. Over the last 10 years, our GUT strategy of 100 US microcap stocks has had an annualized return of more than 11% versus 4.7 for the IWC benchmark. But like any strategy, it has had periods of underperformance, lagging IWC in 2016, and currently this year, year to date. But overall, it has outperformed in 58% of all quarters in the last 10 years. Also interesting to see that it has outperformed more often in down markets than up markets, like we saw with our profitable and growing group earlier. When we add Canada and Europe, we have a portfolio of nearly 250 microcaps with slightly improved performance, both in terms of return and volatility measures such as the Sharpe and Sorrentino ratios. This is a simple strategy, but its purpose is to try and find microcaps based on some of the evidence-based findings we've discussed today, rather than looking microcaps too broadly. As we've seen, microcaps can come in all shapes and sizes. The strategy can be modified and tweaked to find other opportunities, and in fact is the basis for my own investing. We're just scratching the surface as to what evidence-based investing can be. But like any tool, there are pros and cons. And oftentimes it's the limitations that are most important to understand. While evidence-based investing can help provide some clues as to what has driven microcaps' performance, it is still backward-looking, and results can vary over different time periods in different markets, as we've seen, along with different inputs, rules, and assumptions, and even data sources. And markets change and adapt. What worked in the last 10 years may or may not work in the next 10. The data is certainly a good first step, but still requires some judgment to apply it in the future. Microcaps are generally misunderstood, arguably because they are so vast and defy a one-size-fits-all label on many metrics. But this is also what makes microcaps so fascinating as an asset class. Other words that come to mind are exciting, frustrating, rewarding, disappointing. I'm sure you have your own as well. When you use data to help cut through the noise, you can develop a better understanding of microcaps and in turn, better inform your investing decisions. Thank you.
We have time for maybe one or two questions, if anybody has a question for Ryan.
Just wondering, your weighting on your gut strategy, is it equal weighting, or have you
Equal weighting, yes.
equal?
Yep.
And have you divided up the data by value more than growth, or checked or played with it, manipulated it that way?
I rely more on the overall weighting of the factors. So the growth and the value are the first two, and then I just let the system do its thing. Sometimes it may be the value that's driving the return, could be the growth, or the timing, or the sentiment.
One more?
If you filter by liquidity, does that alter the returns?
Absolutely. So, I mean, you can adjust the liquidity to your own personal situation, or just pick very liquid stocks. For this strategy in particular that I showed, I try to be generous on the liquidity, then also added the number of positions to 100, which is a bit more conservative. For myself, I go more around 25, but 100 is a little bit more on the conservative side. Oh. Hello?
How much testing did you do for robustness? Because as anybody who has ever read any study on any subject at any time knows, a common saying is, if you torture numbers enough, they will confess to anything. And if you look at, we've all seen innumerable back testing of market strategies that can make anyone out seem to be a genius. But if you have to have a lot of robustness testing to see how it would actually perform in the real world.
Absolutely. So I've been investing using this strategy, or a variation of it, with many more factors for the last 6 years. And I can say that, yeah, the strategy is robust for my particular situation. Also, as we saw, I like to test across different universes, different geographies, US, Canada, Europe, within different countries within Europe. Also adjust for different liquidity types and market cap levels. The other part, which I was mentioning to the other gentleman, is I like to test with a higher number of positions, which is generally more conservative than, say, getting really focused with 10 or 20 names.
Thank you, Ryan.
Thank you.